Every major country on Earth is in debt. The United States, China, Japan, Europe. Trillions upon trillions owed. Governments say it's normal. Economists say it's manageable. Markets act like it's permanent. But there's a question almost no one asks. A very simple question. If everyone is in debt, who is the creditor? Because debt doesn't disappear into the air. Debt is a claim. For every borrower there is a lender. For every obligation, someone owns the other side of the contract. If governments owe tens of trillions, someone owns tens of trillions and claims on those governments. If households owe mortgages, student loans, credit cards, someone collects the interest. If corporations borrow to survive and expand, someone gets paid before workers ever do. So let's slow down for a moment. Global debt is larger than global production. Much larger. The world produces value every year: goods, services, labor, innovation. But the total debt already exceeds what the entire planet produces in a year by several times. Which leads to a disturbing implication. Even if humanity worked for years without consuming anything, even if every dollar went only toward repayment, the debt still wouldn't disappear. So what exactly is this system? Because this isn't just about numbers. It's about power. Debt decides who works and who collects, who produces and who owns, who struggles to keep up, and who gets paid simply for already having money. We are told debt is neutral, a tool, a necessity. But systems don't last for centuries by accident. This one has survived wars, collapses, revolutions, and crises. It adapts, it concentrates, and it always ends up in the same place. More debt, fewer owners. Here's what most people believe. They think debt works like personal borrowing. You borrow money that already exists. You pay it back with interest. End of story. But that belief is the first illusion. Because modern debt doesn't work that way at all. And once you understand how money is actually created, once you see why interest is the key, you begin to understand something unsettling. This system does exactly what it was designed to do. It doesn't just create debt. It creates dependence. And by the end of this video you'll understand why asking, who is the creditor? Leads to only one answer. A small global elite, operating quietly behind institutions that look neutral, technical, and unavoidable. Before we identify them, before we follow the money upward, you need to understand one thing first. What debt actually is in the modern world. And why the rules guarantee it can never be fully repaid. Most people think they understand debt. You borrow money. You pay it back. With interest. Simple. You imagine a bank with a vault. Money already inside. You take some of it. Later you return it. That image feels intuitive. It's also completely wrong. Because modern debt doesn't work like personal borrowing. Not for governments. Not for corporations. Not even for most banks. In the modern system, money is not lent. It is created. Let that sink in. When a government needs money, it doesn't take existing savings. It issues debt. Bonds. Those bonds are purchased by central banks and commercial banks. And the act of purchase is what creates the money. The money does not exist before the borrowing. It exists because of the borrowing. Numbers typed into a ledger. Digital entries. Assets on one balance sheet. Liabilities on another. No vault. No pile of cash. Just accounting. And here's the critical detail almost no one mentions. When money is created through debt, only the principal is created. Not the interest. If $1 trillion is borrowed, 1 trillion is created. But the obligation is larger. 1 trillion plus interest. So where does the extra money come from? It doesn't. Which means, mathematically, the system is short from the very beginning. To pay interest, someone else must borrow. Or taxes must be raised on money already in circulation. Or assets must be sold. Every option leads to the same outcome. More debt. This is why debt never shrinks system-wide. It can only move, or grow. When one borrower pays, another must borrow. When one government reduces deficits, another expands them. When households deleverage, corporations or states take their place. The system cannot function without continuous borrowing. Not because of bad policy. Not because of corruption. Because of arithmetic. Interest guarantees that total debt will always exceed total money. And once you see that, the next realization follows naturally. Debt is not a temporary condition of the system. Debt is the system. Money enters the economy as an obligation. Every dollar begins its life already owed back, with more attached. This means growth is not optional. It's mandatory. The moment borrowing slows, payments fail. Defaults spread. Banks freeze. Markets panic. So the system is forced to expand. More credit. More leverage. More obligations layered on top of old ones. And here's the part that changes how you see everything. Debt must grow forever. And interest is paid forever. Then whoever receives that interest is positioned at the top of the system permanently. They don't need to work harder. They don't need to innovate. They just need to own claims. The system quietly separates the world into two groups. Those who must borrow to participate. And those who get paid because others borrow. Debtors and creditors. And once you understand how money is created, the next question becomes unavoidable. Who is consistently on the creditor side of this equation? Because it's not random. And it's not evenly distributed. In the next part, we'll look at the mathematical trap this creates. And why, from a system-wide perspective, the debt can never be paid off. Not in theory. Not in practice. And not by design. Once you understand how money is created, the next step is unavoidable. You see the trap. Not a political trap. Not a moral one. A mathematical one. Because when money is created as debt and interest is owed on top of it, the total amount that must be repaid is always greater than the amount that exists. Always. This isn't speculation. It's not ideology. It's basic arithmetic. Imagine a closed system. $1 trillion is created through borrowing. That's the entire money supply. But the obligation is 1 trillion plus interest. That extra amount does not exist. Which means someone must fail unless new debt is created. So new loans are issued. New money enters the system. But those loans also carry interest, which creates an even larger shortfall. This is why debt must grow just to keep the system stable. Not to improve living standards. Not to create prosperity. Simply to prevent collapse. The system needs continuous expansion of debt just to service existing obligations. And the moment that expansion slows, things break. You've seen this before. Credit tightens. Defaults rise. Banks stop lending. Markets panic. Every so-called debt crisis is simply the system briefly failing to grow fast enough. This is why global debt has exploded over the last few decades. Not because people suddenly became irresponsible. Not because governments forgot how to budget. But because the system itself requires exponential growth. Debt compounds. Interest compounds. And compounding never stabilizes. It accelerates. This creates a strange illusion. We are told debt is manageable because economies grow. But debt grows faster. We are told future growth will solve the problem. But future growth requires even more borrowing. So the solution becomes the problem. And the problem becomes permanent. At a certain point, debt stops being something that can be paid back. It becomes something that can only be rolled over, extended, refinanced, pushed into the future. Forever. This is why no major nation ever truly pays off its debt. They don't intend to. They refinance it indefinitely. Old bonds are paid with new bonds. Interest is serviced with new borrowing. The principle is never eliminated. And that brings us to the most important realization so far. If debt cannot be eliminated, then interest never stops. Which means whoever receives interest is permanently positioned to extract value from the system. They don't need to increase productivity. They don't need to take risk. They simply need to hold claims. And those claims grow automatically year after year. This is why debt is not neutral. It is not just a tool. It is a mechanism. A mechanism that ensures money flows in one direction over time. From those who must work, produce, and borrow, to those who already own financial claims. And once you see the trap, the final question becomes impossible to ignore. Who owns those claims? Because the system produces a winner by design. In the next part, we'll step back and answer that question directly. Not abstractly. Not philosophically. But structurally. Who are the creditors of the world? And why is it always the same group? So now we arrive at the question most people never follow to its conclusion. If debt must grow forever. If interest must be paid forever. If the system cannot function without borrowers, who is consistently on the other side of that equation? Who is the world paying? The answer is not everyone. It's not evenly distributed. And it's not accidental. The creditors of the global system fall into a small number of overlapping groups. They look technical, institutional, impersonal. But behind them, ownership concentrates in very few hands. Let's start at the top of the structure. Central banks. Central banks hold massive amounts of government debt. They buy bonds. They collect interest. They are the foundation of the entire debt system. But here's the part most people misunderstand. Central banks are not neutral machines. And in many cases, they are not truly public institutions. They operate through banking systems owned by private financial interests. Their profits flow back into the financial sector. Their policies protect creditors first, stability of the system, not relief for debtors. They enable governments to borrow beyond tax revenue. And in doing so, they lock future taxpayers into decades of interest payments. Next layer. Institutional investors. Pension funds. Insurance companies. Asset managers. Sovereign wealth funds. On paper they exist to protect savings, retirements, stability. In reality they are among the largest holders of global debt. They buy government bonds, corporate bonds, mortgage-backed securities. They earn interest, reliably, predictably. But here's the critical detail. Control does not belong to the people whose money is invested. It belongs to fund managers, boards, executives. Compensation is tied to assets under management. The larger the debt pool, the larger their power and income. And ownership of these institutions is itself concentrated. A small percentage of households owns the majority of stocks and financial assets, which means they own the institutions that own the debt. Next layer. Foreign governments. Countries lend to other countries. Not out of generosity, but necessity. Trade imbalances force surplus nations to recycle money back into the system. They accumulate reserves. They buy foreign debt. This creates dependence. But inside those countries, the beneficiaries are not ordinary citizens. They are political and financial elites controlling state assets. And finally, the most direct group. Wealthy individuals and families. This is where the system becomes unmistakable. At a certain level of wealth, you stop working for income. You lend. You buy bonds. You buy claims. You buy instruments that pay you simply for owning them. Interest replaces labor. $1 billion invested at a few percent yields tens of millions every year, without production, without risk comparable to labor. This is the purest form of extraction. And here's the key insight. These four groups are not separate. They overlap. They reinforce each other. They are often owned by the same people. The same families appear as shareholders. The same networks sit on boards. The same capital circulates upward through layers that look complex, but lead to the same destination. Which means the global debt system has a clear structure. The many borrow. The few lend. And the interest never stops flowing. In the next part we'll follow that flow. How wealth moves upward through interest payments. From workers, taxpayers, and households, to creditors who never need to participate in the real economy. And why this transfer is invisible to most people, even as it shapes their entire lives. One of the reasons this system is so powerful is that most people never see it working. There is no single transaction where you're told, your wealth is being transferred upward now. It happens quietly, routinely, embedded in everyday life. You feel it as pressure, as stress, as the sense that no matter how hard you work, you're always catching up. Let's start with governments. Governments don't pay interest with some abstract money. They pay it with taxes, income taxes, sales taxes, property taxes, inflation taxes. Every year, a portion of what you earn doesn't go to roads, schools, or hospitals. It goes to debt service, to bondholders, which means taxpayers work partly to pay interest to people who already own financial assets. Now corporations. Corporations borrow constantly. To expand. To survive competition. To boost returns. That debt has a cost. Interest. Where does that money come from? It comes from the gap between what workers are paid and what consumers are charged. Lower wages. Higher prices. Fewer benefits. Debt turns labor into a revenue stream for creditors. And then households. Mortgages. Student loans. Car loans. Credit cards. Most people don't borrow because they want to. They borrow because participation in modern life requires it. Housing is unaffordable without leverage. Education is inaccessible without loans. Healthcare often comes with debt attached. So households pay interest directly, month after month. A large share of lifetime earnings doesn't go to building wealth. It goes to servicing obligations. And here's the part that ties it all together. All these interest payments flow into the same places. Banks, funds, insurance companies, asset managers, which then distribute that income to shareholders and owners, who are disproportionately wealthy. So wealth doesn't just move upward once. It moves upward continuously. Every paycheck, every tax payment, every mortgage bill. And because interest compounds, the flow accelerates. Those who receive interest use it to buy more assets. Those assets generate more interest, which is then reinvested again. Meanwhile, debtors remain trapped in repayment cycles. They can't stop paying without defaulting. They can't exit without losing access to housing, credit, or basic stability. This is why inequality grows even in good economic times. Growth doesn't eliminate the flow. It amplifies it. More borrowing means more interest. More interest means more concentration. And the system is designed so that this feels normal. You're told it's responsible to borrow, smart to leverage, necessary to take on debt to get ahead. But very few people ever cross the line from borrower to permanent creditor. That line is guarded by one thing: existing wealth. And this brings us to the next realization. The system doesn't just benefit the wealthy during expansion. It benefits them even more during collapse. In the next part, we'll look at what happens when the debt machine breaks, and why crises are not exceptions to the system but a feature of it. Most people believe crises are failures of the system. Accidents, mistakes, unintended consequences. But in a debt-based economy, crises are not anomalies. They are checkpoints. During expansions, the rules are simple. Borrowing increases. Asset prices rise. Interest flows upward. Those who already own assets see their wealth grow faster than incomes. They collect interest, dividends, and capital gains. But the real advantage appears when the cycle turns. When debt grows faster than incomes. When rates rise. When borrowers can no longer keep up. The system tightens. Credit dries up. Defaults begin. Assets fall in price. And here's where the structure reveals itself. Debtors lose. Homes are foreclosed. Businesses fail. Savings are wiped out. But creditors don't disappear. They are liquid. They hold claims. They wait. Crises turn paper promises into real assets. Land, homes, companies, infrastructure. At discounted prices. This isn't theoretical. It's historical. During major depressions, ownership concentrates. Those forced to sell do so at the bottom. Those with cash and access buy everything. Debt turns volatility into opportunity, but only for one side. Because the wealthy are positioned differently. They don't hold their wealth in a single job, a single currency, or a single country. They hold diversified claims. They hold hard assets. They hold optionality. So when inflation comes, they adjust. When defaults come, they acquire. When currencies weaken, they shift. The middle class cannot. Their wealth is tied to wages, to local property, to retirement accounts exposed to markets, and most critically, to debt. Which means every crisis transfers more ownership upward. Not because of conspiracy. Because of structure. Debt enforces hierarchy. Borrowers absorb losses. Creditors enforce claims. And after each collapse, the system resets with higher concentration of ownership. Fewer independent asset holders. More people dependent on wages and credit. This is why crises never fix inequality. They deepen it. And it leads to a final, uncomfortable truth. The system doesn't need to last forever to succeed. It only needs to extract enough before resetting ownership at a higher level of concentration. In the next and final part, we'll step back and look at the endgame. What happens when debt reaches its mathematical limit? What options remain? And why, no matter which path is chosen, the outcome is already tilted. Unless you understand the system before it moves. Every system built on exponential growth eventually meets a limit. Debt is no different. For decades, the solution to every problem has been the same. More credit. Lower rates. Longer timelines. Kick the obligation forward. But mathematics doesn't negotiate. When debt grows faster than the economy that supports it, the gap widens. Servicing costs rise. Flexibility disappears. At a certain point, the system reaches what looks like a paradox. If borrowing continues, interest overwhelms incomes. If borrowing stops, defaults cascade. There is no painless option. Historically, systems like this end in only a few ways. Defaults, inflation, or debt cancellation under a different name. Each outcome sounds different. Each is framed differently. But the effect is remarkably consistent. Losses are socialized downward. Ownership consolidates upward. In defaults, debtors lose assets. In inflation, savings lose value. In restructurings, rules change, but power remains. And the people best positioned are always the same. Those who hold real assets. Those who hold claims across borders. Those who can move capital while others cannot. The system does not collapse evenly. It fractures along existing lines. Those already exposed to debt feel the pressure first. Those insulated by ownership feel it last, and often profit from it. This is why the question isn't whether the system will change. It will. The real question is who understands it before it does. Because understanding doesn't mean predicting the exact outcome. It means recognizing the direction of force. Debt pulls wealth upward over time. Crises accelerate that pull. Resets lock it in. And that brings us to the final piece. So let's return to the original question. If everyone is in debt, who is the creditor? Not a single person. Not a single institution. But a small global class, operating through layers that feel distant, technical, and inevitable. They lend through banks. They lend through funds. They lend through governments and markets. And they collect, continuously. The system doesn't need intent to function this way. But it was designed with this outcome in mind. Money created as debt. Interest attached permanently. Repayment mathematically impossible at scale. That guarantees one thing. Perpetual transfer. From those who work to those who own. From those who borrow to those who lend. From the many to the few. And because this transfer is embedded in everyday life. Taxes, mortgages, prices, wages. It remains largely invisible. Until it isn't. Until the pressure becomes impossible to ignore. Understanding this doesn't make you immune. But it does give you clarity. Clarity about why the system feels the way it does. Why growth never feels like relief. Why stability always seems temporary. And why the most important financial decisions are rarely about numbers, but about position. If you want to understand how these systems were built, how they evolve, and how power and money quietly move through history, this is exactly what we document here. This channel is called Finance Archives, because the present only makes sense when you understand the past, and the patterns that never really change. If this helped you see the system more clearly, subscribe to Finance Archives. In the next video we'll go deeper into what comes after the limit. What happens when debt grows too large to be managed? Which outcomes elites are preparing for? And what that means for anyone still living inside the system. The debt question has an answer. The next question is whether you're ready for what comes next.